The primary function of an options contract is the industrial-grade transfer of risk rather than a mere vehicle for directional speculation. At its core, an option is a bilateral agreement where the seller, the writer, accepts a non-refundable premium to absorb the risk of a specific price outcome. The buyer acquires the right, but not the legal obligation, to execute a transaction at a predetermined strike price before a fixed expiration date. This creates a fundamental asymmetry. The buyer's downside is strictly capped at the premium paid, while the seller's potential obligation can be theoretically unlimited. Unlike futures, where both parties are obligated to act, the options market is designed to redistribute tail risk from those seeking certainty to those willing to monetize uncertainty. It is important to note that no shares change hands when a contract is written. What is being traded is the probability of a price event. A central structural failure in retail participation is the belief that options are simply leveraged proxies for stock movement. This perspective overlooks the Volatility Risk Premium, or VRP. Research indicates that implied volatility, the market's forward-looking estimate, is systematically overpriced compared to the volatility that actually occurs. This gap exists as compensation for the risk dealers take when providing insurance to hedgers. Furthermore, retail traders often ignore the dimension of time decay, known as theta. An option is a decaying asset. Its value erodes as expiration approaches, with the rate of decay accelerating exponentially in the final days. Consequently, a trader can be correct about the direction of a stock and still lose their entire investment if the move does not occur within the required timeframe. The structural integrity of the options market relies on the Options Clearing Corporation, or OCC, which acts as the central counterparty for every standardized U.S. contract. By interposing itself as the buyer to every seller and the seller to every buyer, the OCC eliminates bilateral counterparty risk. The market is populated by two distinct groups: institutional hedgers, who buy puts as portfolio insurance, and market makers, who provide liquidity. Market makers do not take directional bets. Instead, they earn revenue from the bid-ask spread. To remain market neutral, they immediately hedge their options exposure using the underlying stock or futures. This creates a mechanical link. An options trade triggers a delta-hedging cascade in the equity market, meaning the derivatives layer directly influences the price action of the underlying shares. The pricing of these instruments is governed by 5 variables identified in the Black-Scholes model: the underlying price, strike price, time to expiration, the risk-free interest rate, and volatility. While 4 variables are observable, volatility is an estimate. Implied volatility, or IV, is the market's consensus on future uncertainty derived from the option's current price. Because institutional demand for protection is persistent, the cost of insurance, specifically for put options, is usually higher than for calls. This creates the volatility Smirk, or put skew. Large institutions are willing to overpay for this protection because uncovered tail risk is professionally unacceptable. This structural demand ensures that the volatility risk premium remains a persistent feature of the market, functioning effectively as an insurance premium that is repriced every session. The most significant institutional advantage in this market is an understanding of dealer positioning, specifically gamma exposure, or GEX. Gamma measures the rate at which an option's delta changes relative to a move in the underlying asset. Because dealers must maintain delta-neutral books, they're forced to adjust their hedges as prices fluctuate. When dealers are long gamma, their hedging activity is stabilizing. They sell into rallies and buy into dips, which suppresses volatility. However, when dealers are short gamma, the dynamic inverts. In a negative GEX environment, dealers must buy as the market rises and sell as it falls, creating a self-reinforcing feedback loop that amplifies volatility. This mechanical necessity is often the hidden catalyst behind melt-ups or flash crashes that appear to lack fundamental news. This systemic vulnerability is currently heightened by the proliferation of zero days to expiry options, or zero DTE options. As of late 2025, these contracts represented over half of the SPX index volume. Because zero DTE options have gamma that approaches infinity as expiration nears, even minor price moves require massive and immediate delta hedging adjustments. This concentration means that dealer hedging now dictates intraday price action with unprecedented force. We saw this during the August 2024 Japanese yen carry trade unwind. A surge in put demand flipped the GEX regime into deep negative territory, forcing dealers to sell into a falling market. The resulting spike in realized volatility was not merely a reflection of economic data, but a direct consequence of the mechanical architecture of the options market reaching a fracture point.
An analysis of the slide reveals how macro forces and structural mechanics dictate options behavior, which we can map out step by step. The macroeconomic environment, particularly Federal Reserve policy, acts as a liquidity valve for the options market. Interest rate changes directly affect option values. Rising rates increase the theoretical fair value of calls and decrease that of puts through the carry cost of the underlying. More importantly, the Fed influences the volatility regime. During aggressive rate hiking cycles, the VIX, the 30-day implied volatility estimate for the S&P 500, typically stays elevated and the volatility term structure may invert. In such vol expansion regimes, the cost of hedging spikes and the volatility risk premium may temporarily vanish. Conversely, during periods of Fed accommodation, volatility is compressed, allowing systematic volatility sellers to harvest the VRP with higher consistency. This macro overlay creates humps in the volatility surface around known catalysts like CPI releases or FOMC meetings. For the serious investor, the rational verdict is to view the options market as a precision risk management tool rather than a lottery. Every premium paid is either a calculated cost for asymmetric protection or a structural overpayment for fear. Professional capital exploits these mechanics by capturing the volatility risk premium through systematic carry trades or using the GEX framework to anticipate market sensitivity. Knowing whether dealers are long or short gamma provides a structural information edge regarding whether a price move is likely to be absorbed or amplified. Ultimately, options do not create risk, they move it from those who cannot afford to hold it to those who are compensated to absorb it. Success in this domain requires moving past directional guesswork and respecting the deterministic hedging flows that govern modern market structure.